Have you ever marveled at how some companies effortlessly churn out accurate and dependable financial statements year after year? The secret to this financial wizardry lies in mastering the 8 accounting principles that serve as the bedrock of financial reporting. In this ultimate guide, we're deeply diving into these principles to demystify accounting for you. From the principle of consistency to the going concern principle, we'll dissect each concept in simple terms and provide real-world examples of how they work. Whether you're a seasoned business owner, an aspiring accountant, or simply curious about the financial realm, understanding these principles is necessary. So, let's embark on this accounting journey together and equip you with the knowledge you need to navigate the financial landscape like a pro. Now, let's start by demystifying accounting principles. Number 1. Principle of consistency. This principle is all about uniformity. Think of it like telling a story. Keeping the same language and phrases throughout makes the narrative easier to follow. In accounting, consistency is vital. Companies must prepare their financial information consistently year after year. Imagine examining a company's financial data from 2 years ago and comparing it today. You'd expect things to be similar. That's what consistency entails. For instance, if a company owns a fleet of vehicles and uses a specific method and rate, say 20% per year, to calculate depreciation, they should stick to that method and rate each year. They must disclose this in their financial statements if they decide to change it. This ensures that users like me can understand the financial information provided. Clear, right? Number 2. Accrual principle. This principle revolves around recording transactions. Even when cash hasn't exchanged hands, companies must document these transactions in a particular book and display them in their financial reports. It's akin to saying, "I know no money has changed hands yet, but something significant has occurred." It's like keeping tabs on what's owed and what's owed to you. For instance, consider rent. Suppose a company's fiscal year is ending, but they had not paid the rent for the last month. According to the accrual principle, they must record the rent expense, even if they still need to pay. It ensures that every transaction within a specific time frame is properly noted, whether it's earnings not yet received or expenses incurred but not yet paid. In essence, what matters isn't the actual exchange of cash, but the occurrence of the transaction, which needs to be recorded in the correct financial period. This principle clarifies financial matters for everyone involved. Number 3. Matching principle. This principle is all about synchronization, much like pairing up socks. When a company generates revenue and incurs expenses, these must be recorded in the same financial period and reports. Imagine this: a company purchases inventory, often referred to as cost of sale, and pays for it in cash. However, they will receive payment for the sale later. According to the matching principle, they still need to report both the sale and the cost of sale in the same financial period. Why? Because they wouldn't buy the inventory, cost of sale, if they didn't plan to sell it. So, even if they haven't received payment for the sale, they still need to record both transactions in the same time frame. You can't discuss the cost of the sale now and the sales later. They must be matched in the same period. It ensures everything remains coherent. Number 4. Prudence principle. This principle emphasizes prudence and careful judgment when preparing financial statements, especially in uncertain situations. Caution is paramount when there's doubt about whether someone will pay you back, as in the case of a debtor facing financial difficulties. Accounting may require acknowledging, "We might not recover this money," and writing it off as a bad debt or credit loss. It's akin to saying, "Better safe than sorry." The prudence principle advocates making financial decisions thoughtfully, particularly in uncertain scenarios, to safeguard a company's economic well-being. Number 5. Realization principle. This principle dictates recording transactions when they genuinely occur. When a company earns income, it must record it immediately, but there's a caveat. It can only do so when it has delivered what it promised. For example, if someone pays for products, the company can only recognize that income when it has actually delivered those products. This is what we mean by realization. It's when you've fulfilled your promise. The same applies to expenses. A company can only record an expense when it has genuinely incurred it. If they paid for a service, they can only consider it an expense once they've received that service. The realization principle insists on accurate timing in recording transactions, aligning them with real-world occurrences. For instance, when a company receives an invoice for purchased goods, they record it immediately because they've received the goods. It's all about staying true to the facts. Number 6. Materiality principle. This principle focuses on singling out essential information and presenting it clearly. When a company compiles its financial reports, it must ask, does any information here significantly impact someone's decisions? If the answer is yes, that information must be highlighted. For instance, think about a small company like Counters. If they incur an expense of $20,000 due to an accident, it's significant because they're small. Consequently, they must present this $20,000 separately in their reports. On the other hand, consider a giant corporation like Microsoft. For them, $20,000 or even $1,500 is negligible. They can consolidate it with other expenses like general expenses. The rule is simple. The importance of information depends on the company's size. If something carries significant weight, such as a fine amounting to a substantial portion of their earnings, it must be displayed independently, not buried amidst other data. That's the essence of the materiality principle. Number 7. Economic or business entity principle or business entity concept. This principle emphasizes the importance of keeping things neat and separate. When a company manages its financial affairs, it's crucial to distinguish its transactions from those of its owners or other entities. In essence, what happens within the company should stay within the company. They don't mix their business finances with personal or other companies' finances. It's about maintaining clarity and organization. Company money is for company purposes, while personal funds are for personal use. That's the business entity principle. Number 8. Going concern principle. Lastly, the going concern principle encourages a forward-thinking approach. When a company compiles its financial statements, it assumes it will continue operating for the foreseeable future, rather than suddenly disappearing. This assumption shapes the way they prepare their financial information, making decisions with the long term in mind. It's akin to saying, we're committed for the long haul, and this principle underscores the company's ability to persist in its operations. Understanding these 8 accounting principles is like having a secret key to unlock the mysteries of financial reporting. Whether you're a seasoned business owner or just starting to explore the world of finance, these principles are your guiding stars. Now, let's hear from you. Which of these principles do you find the most intriguing or challenging? Share your thoughts in the comments below. If you found this ultimate guide helpful, remember to give it a thumbs up and share it. And if you want more informative content like this, subscribe to our channel and hit that notification bell so you never miss an update. Thanks for joining us on this accounting journey. Until next time.